Hello, I'm Elon Auerbach of Unitrust Mortgage in San Diego, and welcome to this week's Mortgage Watch, bringing you insight into news that you can use for real estate, finance, and mortgage industry. Well, on the top of the news, Wall Street and the federal government are still figuring out how much bad news is out there in terms of the subprime industry and all the securities issues that are going on. I'll start off with the bad news first. Fremont General, which was a top 10 subprime lender, was ordered by the federal government to kind of sell themselves or divest their mortgage division. They're being sold to a company called Capital Source. They are a huge REIT, and they've been involved in private level financing for quite a few years, and they're going to take over Fremont General. By the way, Fremont was a thrift, which means it had deposits and everything else, so it's one of the first ones that's kind of gone down in the crisis, but at least it was sold before it really got into any trouble. Wachovia, which is a banking giant, announced that it has billions of dollars in more losses. Of course, it also got in billions of dollars of new capital. It's being hammered on Wall Street because people are tired of kind of bad news from Wachovia. If you may recall, about a year and a half ago, they bought Golden West, which is World Savings and Loan, one of the homes of the option arm. They called it the Pick-a-Pay. But bottom line, it was an option arm where borrowers could make a very, very artificially low payment for probably about 18 months to 2 years. Many borrowers were told, well, this is your payment for the next 30 years, which of course is kind of absurd if you think about it. But people got into it. Well, they've taken a lot of losses, and I think that in the next week or two, they're going to drop that program completely. Merrill Lynch took another $8 billion in losses just on Wednesday. And of course, it stayed in the subprime market long after other people had gotten out. It owned First Franklin, and it dealt on the back end with a lot of subprime securities, which just continued to buy and deal in long after the market really seemed to make sense. Bear Stearns has lost a lot of its business in the last several weeks, not just because they were sold to Chase, but just because its clients find it very, very hard to do business with them. It seems like that takeover was arranged just in time. By the way, Bear Stearns was selling for $170 a share in 2007. It was down to $30 a share in February. You may recall it was sold to Chase for $2 a share. It's really up to $10 a share now. But for the people who work there, who put a lot of their money into Bear Stearns stock, not a pretty picture. A lot of losses there. Also, it's come out now that quite a few people on Wall Street are being laid off just before their bonuses are due. You may be aware of this, but a lot of analysts and a lot of people on Wall Street who trade and do stuff like that, they make up to 75% of their yearly income from bonuses that are paid typically between January 1 and sometime in April. A lot of these people are being laid off like the day before their bonus is due, and they're getting a fraction of what they would have gotten. I'm not sure that's really legal, but I mean, we'll leave it for the courts to decide that. In good news, this week we have a couple of issues of good news, and one is that less is actually more. And that is that Chase and Wells Fargo announced lower earnings for the first quarter, but that's actually good news because investors were concerned that they would be taking huge losses. It seems that they're among the two companies, and of course among the two largest, that have taken very, very few hits in this whole subprime disaster. It is kind of an interesting coincidence. I was talking with folks from Chase the other day, but they did very few option arms. They definitely did subprime lending. Chase had a division, and so did Wells Fargo, and they did subprime for many, many years, but they didn't really offer option arms. Interesting to see that they're not really taking a lot of losses and actually have still been making money through all this. In other good news, Freddie Mac is announcing that they're still trying to price out the value of conforming jumbos. Now, as you know, conforming loans are up to $417,000. Jumbo loans are those over $417,000. But since Fannie and Freddie have been given the rights to do loans up to $700,000 and $729,000 in some places, that field of loans is being called conforming jumbo. But they really have never been exactly priced as to where they're going to go. And I believe that in the end, Chase and Wells are going to work with them to try and come up with secure pricing and a way to securitize that arena so we'll have a greater stability. As we've been saying, once we get some stability in there, it's going to end up securitizing is going to be a lot easier. We're going to see better mortgage rates. Mortgage rates continue to be about 1% higher than they should be. So we still believe there's good news on the horizon of mortgage rates coming down, probably in the low 5% range. But one thing that becomes more and more evident is that cash is king and queen. We've often said that, and people have often said that, but it's proven to be true right now. There are quite a few tech companies that are sitting on huge amounts of cash. Apple, Google, Cisco, and Qualcomm, between them, have probably about $250 billion of cash money. They're waiting around to see what they're going to do with that money, whether they're going to be buying other companies, which I'm sure they will. There are also a lot of hedge funds sitting on cash, and even though a lot of hedge funds were damaged by this whole subprime and securities disaster, a lot of them are sitting on the sidelines with huge amounts of cash, just kind of waiting to come in and buy up companies, buy up mortgages, pools, securities, when the price is right. There's a lot of buying opportunities. So the landscape continues to change. There's going to be new winners, there's going to be losers, there's going to be survivors, and there's going to be fatalities. Whenever there's something this major, the landscape changes, new companies emerge out of the ashes, and a lot of old companies are gone as we're seeing companies start to disappear. What kind of lessons are in this for you, the viewer, or for us? I mean, what do we learn from this thing besides knowing what's going on with these large companies? How do we survive and thrive in this market? Well, for me, the lessons are this. Live within your means. A lot of people got into, and I say people, companies got into vehicles and things that they had no business being and couldn't really afford to invest in. If it sounds too good to be true, it probably is. A lot of people who got into option arms really should have known better. I mean, there's no way that those loans could have performed the way people had sold them to them. That's also true on Wall Street. People, again, companies, made huge investments in securities that they knew nothing about. They were just told, well, these are very safe, these are rated AAA, and the return is going to be, 15 or 20%. It sounds too good to be true. It doesn't have to be, but it may very well be. It's always good to do a little bit more research. Always keep liquidity. It's always good to keep cash either on hand and so on. The giant firms are discovering that right now. They're all going out and borrowing more money or getting investment dollars in because they need liquidity for the crisis. The companies that couldn't get liquidity, like Bear Stearns, are disappearing from the landscape. So for you, as an individual homeowner, someone considering buying a home, holds a mortgage, whatever it is, part of your financial plan should always include some liquidity, some fallback money, some emergency money, some rainy day money. These things have always been true, and they're true today as much as they have ever been. Well, last week I ended with the term, keep on the sunny side of life, from the old country western song. I think that's very, very true. It's important to keep a positive attitude. There's a lot of bad news out there, but there's always still a silver lining. Things are starting to find some kind of a base. Home prices are beginning to stabilize. People are beginning to buy homes again and seeing a lot of value. It's never as bad as the media makes it out to be. That's one thing that I had a discussion on last week with this California guru about market prices and so on. The real reality is that prices for homes are nowhere near as bad as the media is making them out to be. That's true nationwide. So it's important to keep a positive attitude about all this. It's easy to get depressed and think that, well, the end is near. It may be, but I don't think so, at least not financially. So I want to remind everyone, keep a positive attitude, keep on the sunny side of life, and it's important to remember the lessons. One of the reasons we share all this information is to know what's going on in the markets, but also to see, well, what can we learn from this? And one of the things we can learn, as I said, is live within our means. If it sounds too good to be true, it may be, and we need to do some more investigation. And always keep liquidity. Just keep a stockpile, keep some emergency money. Be prepared for that unforeseen event that may come along, because as all the Wall Street firms have learned, that can really happen at any time, and you never know how bad it's going to be. So keep that. And also important, keep a stockpile of positive cheer and liquidity in your life. It's important to have a very, very positive attitude when all this is going on, and always be grateful for the many blessings that all of us do share. With that, I want to thank you all for tuning in to this edition of Mortgage Watch. Have a great week, and we'll look forward to seeing you again next week. Thank you.